There are, of course, plenty of stocks out there, but that doesn't necessarily mean that most of them are good opportunities to buy. Today, we're going to be looking at three separate stocks that I believe are relatively cheap right now, and we're starting with Qualcomm. Qualcomm is a stock I like quite a bit. They're up 92% over the last 5 years. Also pay a dividend that is right around 2% at least right now. So this is a company that has performed a little bit above the S&P 500 during this time frame. So because their dividend is substantially higher, while in all honesty, they've probably mimicked the S&P 500 performance. It's somewhere around 90%. I don't know it exactly off the top of my head, but we can say, let's just say they matched. But still, this is a stock that has a PE ratio of 18 right now, which means the S&P 500 is at 30. We're nearly half as cheap as the S&P 500 is right now. And we could say maybe it's distorted off of forward PE. We aren't getting the full picture. We can see forward PE is 14.5 compared to the S&P 500, which is right around that 23 level. So this is a company that is cheaper than the S&P 500. Let's see if we can zoom out on it as well. Yes, it didn't crash on me. That's nice. Since 2015, we haven't performed quite as impressive, although we were kind of at a high in 2015 at 68. If we're going off of late 2015, it's basically tripled in that time frame. Actually, more than tripled. Also, once you factor in the nice dividend they pay as well. So I like Qualcomm. I like them quite a bit. They have a lot of nice contracts with Microsoft. They're what is it, the Snapdragon chip? I don't know it exactly. You probably saw Microsoft was just pushing and pushing that laptop in commercials over and over. We saw that for quite a while. But Qualcomm is increasing in the automotive industry quite substantially. Of course, they're very important for chips in smartphones and things like that. Quietly, I think they've been doing very, very well. And also there was some threats with ARM, specifically ARM threatening contracts and things like that. And they dropped that. So Qualcomm, I think, is in a really safe position. If you want some more exposure to tech, but maybe not high PE, you don't like the PE levels of the market right now, I think Qualcomm is a good option of that risk reward of, hey, you're getting a nice dividend, so if it runs sideways, you don't really care, but you're also getting the upside of tech, a tech company that has performed well and likely can, but also you're getting a little bit of protection with a cheaper PE ratio, although I'm not certain the stock market would view this like a value stock or like a dividend stock, because quite frankly, I'm not sure that it would. Taking a look outside of the tech space, maybe at a stock that isn't quite as attractive, maybe many of you seeing this part of the video are like kind of writing Caterpillar. Caterpillar, that's not something. Look, take a look at it real quick. 172% over the last 5 years. That is a good performance. That is a very good performance. You're outperforming the S&P 500 dramatically. It's only up about 90%. Your dividend's about the same, even at these levels. Very, very good performance. If you zoom out, it didn't freeze on me. I'm happy about that. Early 2015, you're up from what? Somewhere in the 80s. You're up from 80 to 360. S&P 500 only up about 200% over the last 10 years. You're up significantly more than that. This is a company that is outperforming the S&P 500, and you're cheaper. You got 16.5 PE, like we said, compared to 30. Now, it's a little bit different if you look at forward PE. You're only at 18 compared to 23. So it's a little bit closer than it may look when you first take a peek, but still, you are significantly cheaper than the S&P 500 in a company that isn't tech, so you have some hedge against tech. You're diversifying out of it, and you're in a company that's outperformed the S&P 500 by a significant margin, not just 5-10%, a significant margin. So, and also, I don't necessarily think they're in a bad spot. Yes, you could say, okay, maybe they aren't growing as hot as many of these other companies are, and that's true. They aren't expecting tremendous growth. You may take a look at China and say there's slowdown in China. The real estate market, huge, huge, huge thing in China. They always build, build, build. That's like their thing over there, and they're slowing down. Their economy's not doing very hot at all. So you may see some step backs there. That's totally fine. However, in a long-term picture, holding the stock, let's say 3 to 5 to 10 years, that doesn't necessarily concern me. Things will ebb and flow. You'll see it go one way or the other. Here in America, I don't see infrastructure building slowing down anytime soon, despite, I don't like to dive into politics, but sometimes it's important. I don't think either side of the aisle is going to not spend on infrastructure. Obviously, Trump is now in office for 4 years. He spent on infrastructure in his first term, things like that. So I'm not particularly worried about Caterpillar at all with political things like that. Yes, I don't necessarily think they're going to continue to dramatically outperform the S&P 500, but if they matched it and you got that cheapness right now, you're at that lower PE ratio, I wouldn't be surprised at all. And I really think Caterpillar is an okay price at these range. Honestly, I think for a cheap value stock, it's pretty good. So I already know 90% of you watching this video probably have no interest in HCA. Why am I doing it then? Because look at it. I did a video specifically on this company. I dove into it. Almost no one watched it. Terrible click-through rate. I don't care. You need to see this. Look at this stock. This is a healthcare company. You have diversification. Your PE ratio is 14 and a half. I just highlighted everything. 14 and a half. That is half the S&P 500's. Your forward PE ratio is 13. You're nearly half as cheap as the S&P 500 forward PE, which is at 23, 24-ish. And you've gone up 120% over 5 years. Okay, who cares? You zoom out, going back to 2015. You're doing incredibly well. You're up from 70. And going back to 2011, you're up from 34. This is a company that basically since 2015 has 4x earnings per share. 4x earnings per share. That is tech level growth in a healthcare company where you get diversification outside of tech. I know most of you who are watching this video own quite a number of single stocks. If you own quite a number of single stocks, it's mostly all tech. And at the end of the day, if you're holding 80% tech, when the stock market drops, you're going to get absolutely crushed because tech's going to get hit harder than something like healthcare stock. I'm not saying you aren't going to lose in HCA if there was a drop. I'm not saying that, but diversification is important. What if the healthcare industry benefits so much from AI and you see better than expected growth here? You'll probably see that in every industry, and probably a lot of your tech did well, but still, you could do very, very well in a company like HCA. Now, of course, I'm not saying you have to buy it, but pay attention. I don't care. I know a lot of the companies are actually pretty phenomenal. Dividends do well. I think people like the idea of companies paying them money, but a company like even like a Lowe's and a Home Depot, those are two phenomenal stocks. Phenomenal. Look at the performance. Look at the performance over the last 10 years, include dividends. They are shocking. Absolutely shocking. HCA, I have a feeling, of course I don't know, but I have a feeling this, well, it certainly has been looking back 10 years. We may look 10 years in the future and say, wow, HCA, that was probably a pretty good opportunity to hold and buy that. And there's quite a few others as well. Anyways, I appreciate all of you for watching this video. If you enjoyed, if you made it this far, like and subscribe. Many of you who are watching are new. I appreciate you for checking it out. I do content like this all the time. I do deeper dives into specific stocks. I do compilation videos. I talk about the market in general. That's what I'm here for. That's what I do. I appreciate you all for watching. I'll catch you next time.